his take on the mood of the markets. Jason, thanks for being with us. What's been on your mind?
My pleasure. And what's been on my mind is obviously, as of late, it's been the last couple of weeks have been almost all the tariffs show, for lack of a better way to put it. But that may actually be kind of pulling our attention away from other factors that are worth consideration. In the U.S. equities markets, obviously, we went into correction territory. We had a nice bounce back here over the last 2 trading days. In my opinion, a surprising bounce back, especially given the wobbly retail sales data that we saw yesterday. Having said all that, I think that it's very possible that at the end of the day, what we've really been seeing play out in the U.S. equities market is simply mean reversion. We had a market that has gone up and has traded higher over and over again on good data, and probably overbought on good data. And now we're hit with this perfect storm of some underlying potential weakness in the U.S. economy, and then just take the tariffs and the trade war narrative and just throw that gasoline on the fire, and we find ourselves in the situation we've been in here over the past couple weeks. As far as where we move forward, strictly data dependent, in my opinion. We will see what happens with continued economic data, both U.S. and globally, and we'll see what happens as we continue to watch and hear both potential actions and narrative concerning these, a potential trade war and just all the talk around the tariffs.
No kidding. And just to zero in on tech, because there had been so much money, still is so much money in just a handful of stocks that influence the markets, that, their behavior is going to dictate, what we're talking about when it comes to levels for the S&P and such. But, I was saying earlier that the head of NVIDIA has got a big event today, and they'll be talking about their next generation of technology. Will you also be watching how the market responds to what used to be seen as these bullish signs from big tech?
That is a great question. Before I answer that, let me preface by saying, historically as investors, we have always overbought the next big thing. And the next big thing in this example is clearly the AI trade. NVIDIA playing a huge role in that. And to your point, over the past couple of years, whenever NVIDIA has any, has shot what I'll call shiny news, investors have gravitated and bought it up. My feeling is in the tech space that is, valuations are stretched. They're still stretched. Yes, we're off the highs. But I would be surprised if investors got as giddy and got as excited and hyped up on the next new, depending on what we hear on this later on. But, I'm not bearish on technology. I think there's huge opportunity there, but I feel like I'm realistic and measured on technology. And that's specifically placed to your point where U.S. equities the S&P is so cap weighted in these big mega cap tech names that it's just, look under your portfolio as investors and make sure that you are aware of how much money you have tied to, whether it's, an individual name or whether it's a sector, the big tech sector. And if you are overweight in those areas, it might not be a bad idea to consider trimming some high flyers, although they're a little lower than they were at their all-time highs. So we'll see.
We will. And that's an interesting point about the sentiment surrounding tech, even when there is something that could be, very exciting about the future. Since you mentioned sectors, let's just wrap things up there because, here in Canada, obviously a lot of worries about where the economy goes. But that doesn't mean there aren't some sectors that are in positive territory this year, including utilities. In the U.S., utilities as a group were up this year. In the U.S., healthcare as a group is up this year. And I wonder how you're thinking about portfolio positioning outside of what's going on with technology.
Yeah, absolutely. So if we're looking at considering maybe needing to do some rebalancing in a portfolio because we've gotten too overweight in a particular space or a sector or an individual name. Healthcare, we're seeing the bump so far this year. Healthcare was pretty much traded flat last year and was, I don't want to say dead to the wind, but there was really no story on healthcare. And then conversely, technology was gangbusters, right? So we may just be seeing a phase of mean reversion play out here, both in the technology and the healthcare sectors respectively. Utilities had a good year last year, and they're doing well this year, but it's also considered to be obviously a very defensive space. So when we're worried about stuff, happening, whether it's economic data slowing, or we're worried about a potential recession, or we're worried about a trade war, it's not necessarily unnatural to see some sector rotation and some money fly out of the more cyclical stuff into the more defensive spots like the utilities. I also want to point out one area that I'm surprised hasn't gotten more attention over the past month or two, and that's U.S. small company stocks. So historically, U.S. small caps are much more insulated from tariffs and trade issues than their large company peers, right? As a whole, they import just a lot less in terms of goods and services. So if we're truly worried about where and how that might unfold, but we also want to maintain the same level of exposure that we have to U.S. equities, I would consider, if you're overweight in any particular area, there's a very good chance you also might be underweight in U.S. small caps right now. And I think there might be some opportunity there. And if not opportunity, at least some significant defensiveness in the portfolio. If tariffs are going to be some sort of thing moving forward, which it certainly looks like we're looking at that moving forward in 2025.
Yeah, it does feel that way. Jason, thanks very much.